United States, we have 370% public and private debt as a percentage of GDP. So if you had corporate debt, household debt, and public debt combined, it's 370% of GDP or so. And that's basically unpayable in real terms. And so the question becomes, how does that default? Does that default nominally? Probably not, because the liabilities are in our own currency. And so instead, you generally are going to get default through inflation. Where you're just gonna have a long period of negative real rates, and so those bondholders will get paid back, but not necessarily, not in real terms. The inflation that we're going to get, which now we have, is in large part driven by fiscal spending. And the difference, for people that don't know the difference, monetary policy is like what the central bank does. It's like, what are interest rates going to be? Are they doing quantitative easing or quantitative tightening, that sort of thing? Whereas fiscal policy is basically about taxing and spending by Congress and the president. And especially when you get extreme fiscal policy, unusually large multi-trillion-dollar deficits, that actually puts money out into the broad money supply. And so if you look back at, say, the 2008 crisis, for example, there was a large monetary response. So we saw the base money go up quite a bit, but most of that just stayed in the banking system. It didn't actually really circulate to the general public. It's not like you and me got checks sent to us that we could then use to buy things, right? So it's not like people had more purchasing power. There was not a realistic version of more money chasing same goods. Whereas what we saw in the 2020 response was, in addition to the monetary response, we also had things like helicopter money, PPP loans that turn into grants, basically just tax cuts that are not offset by anything else. And so that was a large injection directly to people's bank accounts in different ways. We also saw corporate bailouts, for example. And so in that type of environment, you actually have a broad money supply increase. There's actually more money that people can control chasing the same number of goods and services. And of course, the monetary policy is still relevant because they're printing money to buy the bonds that is enabling the fiscal expenditure. Because if they tried to just issue trillions of dollars of bonds, they'd have problems with liquidity. Like, there wouldn't be enough buyers showing up to buy those treasuries. And so the central banks are monetizing that fiscal. So it's really that blend of monetary policy and fiscal together, as well as, of course, real world constraints that we've run into, right? So the fact that we had underinvested in, kind of physical goods, like, oil capex and things like that for a few years was also the supply side of this whole inflation thing.
Is it fair to break down the most simplistic analysis being monetary policy drives liquidity into the financial system, but fiscal policy drives liquidity into the hands of people? And because we got both in 2020, the monetary policy drove the asset bubble and the fiscal policy drove the inflation. So kind of all items went up in price. Some of them were investment assets, some of them were consumer goods and services. Is that a way to break it down? Or could the fiscal policy actually have also had an impact on the asset prices going up as well?
I think you described it well, but I would say that fiscal impacts both. So I think that monetary policy, specifically QE, putting liquidity into the system, is generally pretty good for financial assets, whereas fiscal policy is basically consumer price inflation, as well as because that consumer price inflation is resulting in more revenue and things like that for various businesses, at least in nominal terms. It's also generally good for asset prices in nominal terms. Whether it's in real terms is another story. And a good example of this is Japan, because if you look at their QE, they did more QE as a percentage of their GDP than like any other major country. They have, their balance sheet's over 100% of their GDP, whereas the United States, it's like, under 40%. And it looks like a Weimar chart if you look at their base money, but because it wasn't combined with huge fiscal expenditures, their broad money supply actually went up pretty slowly this whole time. And if you look at Japan, so they're well known for like their 30-year bear market, where their equities are still literally like cheaper than they were in the beginning of the 90s. But that wasn't like a sideways market. You had a couple decades of downturn, and then starting around 2012, Japan actually had a pretty strong equity bull market. It was like one of the, outside of the US, it was one of the better performing equity markets over the past decade. And that's specifically when their QE started really ramping up. in 2012. They started printing a ton of money in 2012. They never really stopped, and that included for them, unlike the Fed, buying equities. And so if you look at Japanese equities from 2012 and you look at their QE from 2012, there's a pretty strong correlation with that being very good for their equity market. But it wasn't consumer price inflationary for Japan because, again, it wasn't combined with things like helicopter money or things like that.
When most people look at high inflation in the United States, like we're experiencing now, they point to the 1970s. Your analysis for a while now has been rooted in not comparing current environment to 1970s, but rather the 1940s. Can you elaborate a little bit on what was going on in the 40s that makes it a much more attractive comparison in your mind?
Sure. So in the 1970s, a lot of the inflation that we had was from bank loans, right? So there were fiscal deficits, but they weren't the biggest driver of what we're having. There was a demographics boom. So there was, the boomers were going into their home buying years, and so there's this rapid increase in demand for things. And so you got a pretty significant money supply growth, but that was because a lot of banks were lending money into existence. And then, of course, you threw on top of that, the guns and butter program. So you threw on some fiscal deficits on top of that. And that was combined with the fact that the key similarity to the 70s is that we had an energy supply problem. So U.S. oil production peaked in 1970 after 100 years of constantly going up. And so we became more reliant on the Middle East. And so we obviously had some geopolitical turmoils with that and trouble getting the oil supply we need up against a time of very huge demand that was largely demographics and bank loan driven. Whereas if you go back to the 40s, the reason that's more similar is because that inflation was not driven by bank lending. Banks weren't really lending a ton during that era. Instead, that was driven by massive fiscal expenditures. And so, the 1930s, were a lot like the 2010s in the sense that, the 1929 crash and the 2008 crash were pretty similar. You had a gigantic private debt bubble blowing up. Then you had this long period of stagnation, rising populism, kind of just rising economic fragility. And then in the 1940s, they were hit with an external shock. Basically, a lot that populism had spread around the world. You got these wars started to materialize, and so they had to do they did large fiscal expenditures, and a lot of that was in the domestic economy. And they were building manufacturing facilities. They were hiring people. When the soldiers came back, they sent 8 million of them into technical school and college, and then helped them get a mortgage. These were very large fiscal expenditures, and so you had a huge increase in the money supply, and that was, as you'd expect, pretty inflationary. And then the key difference is, so in the 70s, debt as a percentage of GDP, both public and private, was pretty low. And so when they encountered inflation, they could raise rates to double-digit levels to try to quell inflation and give positive real rates. Whereas in the 1940s, because you had so much fiscal expenditure to fight the war, you had over 100% debt to GDP, and so they couldn't really raise rates to match inflation levels, and so they just let it run hot, and you had the biggest ever gap between inflation and interest rates. And in fact, they even pegged the long end of the treasury curve, like what Japan's doing now. And so this environment here in the 2020s, I think, is pretty similar because, one, the growth in the money supply is largely a fiscal phenomenon. It's not due to unusually high bank lending. It's due to unusually large fiscal deficits that are monetized by the Fed, which, again, actually they did that back in the 40s. So there was huge QE in the 40s to monetize it. It's not due to excessive demand or positive demographics. It's due to that more strained geopolitical environment and that strained economic and socioeconomic environment.
You mentioned populism and its relationship with fiscal policy. Obviously, social media has made it much easier for people to communicate around the world. And it feels like every day there's some new thing that people are upset about, or kind of, cancel culture is running wild, or there's virtue signaling going on. And obviously, politicians are not immune to getting caught up in kind of the whims of the flavor of the day, if you will. How much do you think the expansion of fiscal policy that we've seen is just, there's an easier way for folks to communicate? They can tweet at politicians, they can make their voices heard, they've got podcasts and YouTube and kind of all these different platforms. And that means that politicians now are more likely to kind of hear the people, and that leads to kind of bigger and bigger and more severe and aggressive fiscal policy kind of programs.
I think it's a combination of that and then the debt. So the debt portion is the fact that when debt is super high, when you have hundreds of percent, like so in the United States, we have 370% public and private debt as a percentage of GDP. So if you had corporate debt, household debt, and public debt combined, it's 370% of GDP or so. And that's basically unpayable in real terms. And so the question becomes, how does that default? Does that default nominally? Probably not, because the liabilities are in our own currency. And so instead, you generally are going to get default through inflation, where you're just going to have a long period of negative real rates. And so those bondholders will get paid back, but not necessarily, not in real terms. And so large fiscal expenditures, while holding rates low, are one of the main ways to inflate away large levels of debt. So I think that's the mathematical component, and then the more social component is that populism, and generally, that kind of goes back to the fourth turning concept of people build these institutions, and those institutions last for decades. But then over time, as the founders they die, and then as you get kind of the third and fourth generation of these institutions, they drift away from their original purpose, or they become corrupted, or society has changed and no longer respects those institutions, usually a combination of all these things together. And so in that period of rising populism, they generally feel that the institutions, the frameworks that we've constructed, are no longer working well for the majority of the people. And so you start to get a lot of pushbacks on it. That could be the government, that can be media, that can be certain corporations, basically certain international organizations. And when you start to get that pushback on that, you get this broad distrust of that sort of thing. And you have just kind of like that very fragile system from how much debt's there. And so I think in that, when they're hit by an external shock, I think they err on the side of basically money printing, because in their mind, it's better than debt collapse. And so generally, when you get the end of a long-term debt cycle like we're at now, it tends to die in fire rather than ice, meaning that you tend to err on the side of high inflation rather than deflationary collapse.